Hello and welcome. If you run a restaurant, you know that cash flow is oxygen, and sometimes traditional banks just tighten the air supply. So you start looking for alternatives, and lately, one name keeps popping up everywhere: InKind. It sounds like a dream: upfront capital, no interest, just food credits. But before you sign that deal, we need to talk about exactly what you're getting into. In the next few minutes, we're going to unpack how InKind works, why it's turning heads across the industry, and most importantly, how to account for it correctly so your financial reports stay accurate and fraud resistant. Let's set the stage. So here's the real question driving everything we're about to explore. How does this machine actually work? And is it truly cost effective? It's not a donation, it's a trade. You sell a large block of food credits to InKind at a 50% discount. They hand you cash today. You give them the right to send customers to your tables later. Those customers get a 20% discount on their bill, while InKind pockets the spread between what they paid and what they gave away. It takes pressure off your bank account right now, but you're essentially pre-selling your future inventory at half price. Here's the kicker, though. Traditional financing is often worse. Banks see restaurants as too risky, merchant cash advances can hit triple-digit rates, and equity financing costs you ownership of your dream. So InKind spots a real opportunity. But to know if it's worth it, we need to examine exactly where the numbers land and where the traps hide. Here is the dangerous gap where so many restaurant owners fall. When that $60,000 wire hits your bank account, the temptation is to celebrate it as revenue or sales. Do not do that. If you treat this cash as income, you will inflate your tax bill, distort your profit margins, and hand your accountant a nightmare. And here's the other trap. If you don't track these credits properly in your point of sale system, your staff might use the InKind payment button as a catch-all to comp meals for friends, and you'll never catch it. Every comped meal disappears into the liability balance, invisible without a proper reconciliation process. The gap is clear. Restaurants need to understand that this advance is a loan against future sales, with roughly a 52 to 55% effective promotional cost baked in. Misclassify it, and you're not just confused. You're exposed to tax disasters, hidden theft, and financial reports that no longer tell the truth about your business. To navigate this safely, we need a rigid accounting framework, one that keeps your books honest from day one. Think of those unredeemed credits not as income, but as a debt you owe to future diners. Step 1. Add InKind as a dedicated payment tender in your POS system so every redemption is tracked separately. Step 2. Build 3 specific accounts in your chart of accounts: an InKind credit liability to track the gross credits outstanding, a contra liability to track the 50% discount, and an InKind promo expense account on your P&L. Step 3. When that advance arrives, you must gross it up. If you received $60,000, you don't just record a $60,000 loan. You record the full $120,000 as a credit liability. That's the food you now owe. Then you debit cash for $60,000, debit the contra liability for $60,000, and credit the full gross liability for $120,000. This keeps your balance sheet telling the true story. You hold $60,000 in cash, but you owe $120,000 in future dining. Steps 4 through 7 are where the real-time mechanics unfold. Let's walk through them now. Now let's walk through what happens when a customer actually sits down. A guest enjoys a $100 meal. With tax, the bill is $110 plus a $20 tip, $130 total. They pay with the app. In your POS, you ring it up, and the full $130 reduces your InKind credit liability. You credit sales for $100, sales tax payable for $10, and tip payable for $20. But here's the critical detail. The tip does not come from the credits. Tips are paid separately via credit card and routed through Stripe. When Stripe remits the tip, net of its processing fee, you must gross it back up so your liability balance isn't understated. If Stripe sends you $19 after a $1 fee, you record the full $20 back as a credit to the liability. At month end, your InKind credit liability balance must match exactly what InKind's statement shows as outstanding credits. If it doesn't, you investigate immediately. This monthly true-up is your reconciliation checkpoint and your early warning system for any irregularities. Now let's talk about what these findings mean in the real world. First, the 50% discount never flows through your POS, so you must record a promotional expense separately each period. Calculate credits redeemed times 50%. If $110 was redeemed, record a $55 promo expense by debiting in-kind promo expense and crediting the contra liability. This ensures your financing cost matches the sales it supported in the same period, not a lump sum when you first received the cash. Second, this reconciliation process is your fraud detection system. Without it, anyone with POS access can use the in-kind button to comp meals, and the missing credits simply vanish into your liability balance. The monthly true-up exposes every discrepancy. Third, for restaurant groups with multiple locations and different ownership structures, this accounting becomes absolutely critical. The management company may receive the advance at one location, but credits get redeemed across all 5 venues. Without precise tracking by location, you're inviting partner disputes and potential litigation. The system gives you actionable intelligence: which locations are driving redemptions, what your true promotional costs are, and whether the capital advance is generating returns that exceed its cost. So what's the big picture resolution? In-kind is not free capital, but it can be genuinely cost-effective in the right scenario. Compare it to a merchant cash advance, bleeding you at triple-digit rates, or equity financing that costs you permanent ownership. An effective discount of 52 to 55% in exchange for interest-free capital tied directly to your revenue rather than your credit score is a real alternative worth evaluating. For restaurant groups especially, where credits can span multiple locations while one entity receives the advance, the structure can be powerful, but it comes with conditions. If you need GAAP-compliant financials, the complexity ramps up significantly. You must treat the advance as a loan, accrue interest monthly on the net liability balance, and estimate breakage revenue on credits that may never be redeemed, all in accordance with ASC 606. The decision is clear. Use InKind if you need upfront capital, can operate within the exclusivity constraints, and have the accounting discipline to manage monthly reconciliation. It is a financing tool, not a shortcut. And when used intentionally, with precision and proper systems, it can fuel growth without surrendering ownership or drowning in interest payments. Let's bring this home with what really matters. Key takeaway number 1, that in-kind advance is a loan against future sales, not revenue. Treat it as a liability on day 1, gross it up to the full credit value, and never let it touch your income line. Key takeaway number 2, monthly reconciliation is not optional. It is your fraud prevention system, your accuracy checkpoint, and your early warning radar for anything that doesn't add up. Key takeaway number 3, you're looking at an effective 52 to 55% discount. That only makes sense if the upfront capital drives growth that exceeds that cost. So run the numbers honestly before you sign. The accounting framework we walked through today, 7 disciplined steps from POS setup to promo expense recognition, is what separates restaurants that use in-kind as a strategic advantage from those that let it become a financial liability. If you're considering in-kind, first assess whether you have the bookkeeping resources to execute this correctly. If you're already using it and your books are a mess, now you have the framework to fix it. Precision protects profit. And with the right systems in place, even unconventional financing can become the foundation for sustainable growth. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.